hidden signals in the economy, what ISM PMI and JOLTS just revealed. When two numbers tell the truth. On the surface, it looked like just another week of economic data, another round of numbers most people ignore. The ISM manufacturing PMI came in weaker than expected. Again. Meanwhile, the JOLTS job openings report surprised some analysts with fewer vacancies than forecast. To the average investor, this might feel like background noise. But to those watching closely, these two data points are flashing red. Not because of what they say individually, but because of what they say together. Think of it like this. One report is showing us how much the engine is slowing down. The other is showing us that the wheels are still spinning, but not for long. The U.S. manufacturing sector is contracting. The labor market, while still tight on paper, is quietly losing momentum. And the gap between the two is getting wider, dangerously so. What's happening behind the scenes is a silent divergence, the kind that usually happens before something breaks. Whether it's consumer demand, inflation, interest rates, or market confidence, the numbers are whispering before they scream. In this video, we'll break down what the ISM PMI and JOLTS data really reveal, and why these reports matter far more than Wall Street wants to admit. We'll explore how the disconnect between production and employment is sending a powerful warning, and what this means for central bank policy, risk assets, and the next big move in gold and crypto. Because in this economy, the truth isn't in the headlines. It's in the details. If you're serious about understanding what moves markets, not just reacting to them, make sure to like this video. Subscribe to Money Minded, and share it with someone who still thinks the job numbers tell the full story. Let's dig in. Chapter 1, ISM PMI, a manufacturing meltdown? For the 14th consecutive month, the ISM manufacturing PMI, one of the most reliable leading indicators in global macro, has remained below 50. That number may not sound alarming. But here's what it means. Every time the PMI falls below 50, it signals contraction in the manufacturing sector. And now, we're not just dipping, we're sinking. The most recent print came in at 47. 2, lower than expected and firmly in recessionary territory. But here's the catch, manufacturing accounts for just 11% of US GDP. So why should you care? Because in macroeconomics, it's not the size of the sector, it's the signal it sends. Manufacturing is forward-looking. Before companies slash jobs, they cut orders. Before banks tighten credit, they pull back on funding for industrial expansion. And before recessions become obvious, PMIs collapse. That's what's happening now. A closer look at the components of the ISM report reveals even more troubling signs. New orders index, down again, suggesting future output will slow. Employment index, now also in contraction, meaning factories are starting to cut labor. Inventories, building up, not being sold, a classic pre-recession dynamic. Prices paid, rising, which means inflation isn't done yet either. So what does this tell us? We're witnessing a toxic combination, shrinking demand, cautious employers, rising input costs, and a policy environment that remains tight due to lingering inflation. This is the kind of setup that leads to stagflation, or worse, a hard landing. But here's the most misunderstood aspect of the PMI data, the time lag. In 2007, PMI fell into contraction 6 months before the Great Recession was officially recognized. In early 2020, the index collapsed before the COVID shock fully hit the broader economy. And in 2023 to 2025, we're seeing the same pattern emerge. Yet markets remain complacent. Why? Because the S&P isn't crashing. Because the unemployment rate hasn't spiked. Because most investors are trained to follow lagging indicators, jobs, earnings, retail sales, instead of leading ones like PMI. But for smart capital, PMI is the canary in the coal mine. And this canary is coughing. Let's talk sectors. Durable goods, like cars, machinery, and electronics, are showing weakness. Export orders are shrinking. Domestic demand is soft. And smaller manufacturers, the ones most sensitive to credit conditions, are pulling back aggressively. This is where the impact of tight Federal Reserve policy becomes visible. Higher interest rates don't destroy demand instantly. They suffocate it gradually, starting with capital-intensive, debt-reliant sectors. That's manufacturing in a nutshell. Now, some analysts argue that the US economy can decouple from manufacturing. After all, services are strong, the consumer is spending, and the labor market still looks tight. But here's the flaw in that logic. Manufacturing may be small in GDP terms, but it plays a disproportionate role in economic momentum. It drives logistics, energy, materials, transport, and global trade flows. When it slows, the ripples eventually hit the rest of the economy, especially when services start to wobble too. We're not there yet. But we're close. And if this slowdown continues, or worsens, here's what you can expect. Bond yields could fall as traders begin pricing in recession risks again. Gold may rise as investors seek safety amid slowing growth and sticky inflation. Stocks could correct sharply, especially in cyclicals and industrials. Crypto could benefit or suffer depending on whether the Fed responds with easing or stays behind the curve. The bottom line? The ISM Manufacturing PMI isn't just another number. It's a warning shot. One that's been firing for over a year, and now growing louder. If you're ignoring it, you're missing the earliest clues of what's coming. In the next chapter, we'll look at the JOLTS job openings report, and what it reveals about the strange strength of the US labor market, or the cracks just starting to show. Stay with us, and if you haven't yet, like this video and subscribe to Money Minded. Because when the signals are this subtle, you need a channel that reads between the lines. Chapter 2, JOLTS. Cracks in the labor market or just noise? If the ISM PMI tells us the engine is slowing, the JOLTS report asks, is the vehicle still moving forward, or just coasting on momentum? The Job Openings and Labor Turnover Survey, JOLTS, is often overlooked by retail investors, but it's one of the Fed's favorite indicators. Why? Because it provides more than just an unemployment number. It shows how confident businesses are in hiring, and how confident workers are in quitting. Let's look at the latest numbers. In June 2025, job openings in the US fell to 7.9 million, down from over 10 million at the peak in 2022. That's a 20% decline year over year. Quits, a proxy for worker confidence, have also dropped steadily. Meanwhile, layoffs are rising modestly, and hiring rates have stagnated. This isn't a collapse. Not yet. But it's a cooling trend, and it's becoming more difficult to ignore. The headlines will say, the labor market is still strong. The reality is, the demand for labor is slowing, and silently at that. Here's what's really happening under the surface. 1. The labor market is becoming more sticky. Companies are reluctant to fire, but also hesitant to hire. That's not strength. It's caution. This is especially true in industries sensitive to rates and credit, construction, tech, real estate services, and logistics. These sectors are freezing headcount. Not because demand is surging, but because visibility is dropping. 2. Quits are falling. That's not always good. Fewer people quitting may sound like stability. In fact, it's the opposite. When people stop quitting, it often means they don't believe they can find a better job. That signals lower confidence, not higher satisfaction. And historically, falling quits lead rising unemployment by several months. 3. Wage growth is stalling. JOLTS doesn't directly measure wages, but it hints at where they're going. And here's the signal. Less hiring plus fewer quits equals slower wage pressure. That's great news for inflation, but bad news for consumption. Consumer spending drives 70% of the US economy. If wages stagnate while prices stay high, we enter a dangerous zone, real wage erosion, where people feel employed, but poorer. For labor hoarding is over. During the post-pandemic boom, firms hoarded workers, hiring more than they needed, afraid of future shortages. But now, that narrative is fading. Companies are trimming headcount, quietly and surgically. Not layoffs en masse, yet, but natural attrition with no backfill. And once that cycle starts, it tends to accelerate. So, is JOLTS noise, or signal? For months, the labor market seemed impervious to rising rates. It was the final pillar holding up the soft landing narrative. But now, that pillar is shaking. The lag effect of Fed policy is real. First it hits housing, then credit, then manufacturing, and last, employment. We're not seeing collapse, but we are seeing the cracks. And in macro, cracks matter more than chaos, because they appear before the avalanche. For traders and investors, this means two things. Rate expectations may shift. If JOLTS continues cooling, the Fed will have to consider the trade-off. Fight inflation at the risk of breaking jobs. And that could push the market to price in rate cuts sooner than expected. Asset classes will react differently. Bonds may rally as growth slows. Equities could falter, especially small caps and cyclicals. Gold may shine as confidence in policy fades. Crypto becomes the wild card. Will it act as risk-off or speculative asset? But here's the bigger question. If both manufacturing and hiring are cooling, what happens next? Because one weak report can be noise. 2. Coincidence. But a pattern? That's a warning. And that brings us to the heart of this video, the growing divergence between economic reality and market perception. In the next chapter, we'll connect the dots and show you how these signals are being misread by Wall Street and what that could mean for your portfolio in the coming months. Before we go there, make sure you've liked this video and subscribed to Money Minded. We break down complex market signals so you don't have to guess where things are heading. Let's move on. Chapter 3, Divergence. Why markets are getting it wrong. For anyone watching the macro data closely, ISM PMI, JOLTS, consumer sentiment, freight volume, even leading credit indicators, the picture is clear. Things are slowing down. Demand is weakening. Hiring is softening. Prices remain sticky. And yet, markets are rallying. The S&P 500 just hit a multi-month high. Tech stocks are flying. Bitcoin is holding up. Bond yields have barely moved. It's as if investors are looking at the same economic landscape and seeing nothing to worry about. This is the divergence. And this is where smart investors start asking the most important question. What does the market believe, and what if it's wrong? 1. The myth of the soft landing. right now. Wall Street is pricing in the perfect scenario: inflation falls on its own, growth slows but doesn't crash, and the Fed cuts rates just enough to avoid a recession without losing control. That's the soft landing dream. The problem? It almost never happens. In the last 50 years, every time the Fed has paused after aggressive rate hikes, recession followed within 12 to 18 months. The lag is real. And the danger isn't immediate collapse, it's complacency. Markets are extrapolating from lagging indicators: jobs still look fine, consumer spending is okay, and earnings haven't collapsed. But this misses the turning point. Leading indicators, like PMI and JOLTS, don't scream. They whisper. And the market often chooses not to listen. 2. Liquidity versus fundamentals. One reason for the market's optimism? Liquidity. Despite tightening in the US, global liquidity remains relatively loose. Japan hasn't raised rates meaningfully. China is injecting stimulus. Europe is cautious. And US Treasury buybacks have injected some calm. But liquidity doesn't fix fundamentals. The real economy runs on demand, wages, confidence, and credit, not on stock buybacks or central bank optics. And when those real drivers weaken, markets eventually respond, often violently. 3. Narrative momentum. Markets are driven by stories. Right now, the dominant story is: inflation is coming down. The Fed is done. Tech will lead. AI will save us. Growth is slowing, but it's manageable. That's a seductive story. But what if it's based on lagging data and wishful thinking? ISM shows demand destruction. JOLTS shows hiring hesitation. Inflation remains above target. Oil and food prices are rising again. Geopolitical risk is growing. And yet, market positioning is near euphoric levels. This is where the trap is set. Because when everyone's on one side of the boat, it doesn't take a storm, or just a wave, to capsize sentiment. For false signals from the labor market. As we saw in Chapter 2, the labor market still looks strong, until it doesn't. Every major downturn begins with denial. It's just manufacturing. It's just temporary. The consumer is resilient. The Fed has this under control. Sound familiar? The same lines were used in 2000. In 2007. Even in early 2020. What makes this time different? Nothing, except the amount of debt, leverage, and belief baked into asset prices. 5. Why this divergence matters for you. If you're an investor or trader, this divergence between data and narrative creates both risk and opportunity. Risk, when the market wakes up to the slowdown. It won't do so gradually. It'll reprice violently. That means downside in equities, especially in cyclicals, small caps, and overhyped growth names. Opportunity. For those watching leading indicators, like you are now, there's a chance to position early. Rotate into defensive sectors. Look at gold as a store of trust. Watch bond yields for clues of Fed pivot. Stay liquid, stay flexible. Because when reality finally breaks through narrative, those who saw it coming aren't caught off guard, they're ready. In the final chapter, we'll connect all the dots, and look at what these quiet signals from the ISM and JOLTS really mean for the months ahead. We'll break down actionable strategies. And what the mainstream isn't telling you. If you haven't yet, hit like, and subscribe to Money Minded, the channel that doesn't just read the headlines, but reads between them. Let's finish strong. Conclusion: the quiet signals before the storm. Recessions don't announce themselves. They don't arrive with sirens blaring or breaking news banners flashing across the screen. They start with small things, overlooked reports, declining confidence, tightening credit, and they build. Quietly. Gradually. Then suddenly. That's what makes this moment so dangerous. On the surface, the economy appears resilient. Jobs are still being added. The stock market is up. Consumer sentiment has bounced. But dig deeper into the ISM PMI, the JOLTS data, freight volumes, business inventories, and the story changes. You begin to see a pattern. Factories are slowing. Orders are shrinking. Hiring is freezing. Confidence is slipping. These aren't isolated data points. They are signals, subtle. Early-stage indicators that something more serious is developing beneath the surface. And yet, the markets remain calm. That's not unusual. In fact, it's how nearly every major financial turning point begins. Investors mistake noise for signal. They chase the last rally, not realizing the music is fading. We're not here to predict collapse. We're here to recognize fragility and prepare for it. Because the worst kind of financial mistake isn't being wrong, it's being unprepared. Whether you're a trader, a long-term investor, or simply someone trying to understand where the world is heading, this is the moment to think clearly, act cautiously, and position intelligently. So what can you do? 1. Watch the data. Not the narrative. Ignore the feel-good headlines. Focus on leading indicators like PMI, JOLTS, credit spreads, and bond market behavior. These tell you what's coming, not what's already happened. 2. Respect the lag. Economic policy takes time to work its way through the system. Just because nothing's broken yet doesn't mean the pressure isn't building. Be patient, but vigilant. 3. Diversify with intent. This isn't about fear. It's about resilience. Spread your exposure across assets, geographies, sectors. Own things that hold value when confidence collapses, like gold, high-quality bonds, and certain forms of real estate. 4. Don't chase euphoria. When markets ignore data, they create opportunities, not certainty. Stay skeptical of parabolic rallies without fundamental support. If everyone's on the same side of the trade, that trade is already crowded. 5. Stay curious, stay educated. That's why you're here. Watching this. Learning. Thinking beyond the surface. That's what separates you from the herd. Because when the storm comes, and eventually it always does, those who paid attention to the quiet signals won't just survive. They'll be the ones who lead. Thank you for watching this deep dive from Money Minded. If this video helped you see the bigger picture more clearly, please like the video. Share it with someone who needs to understand these market signals. Subscribe to Money Minded, where we decode the global economy without hype or noise. And as always, stay sharp. Stay skeptical, and stay ready. Because the quiet signals never lie.